When we're looking at the roll date, and that can be easily seen through the CME site. I think I have that up here. So you can go to the CME and look at that roll date, or just even Google it, you know. And one of the things we sent out as an alert was the fact that today's the first day for that December contract. And that's because not that the open interest has moved in a way that we have majority of OI in December, but basically I used to call this the pit date, where the pit rolls from September to December. I used to call it the pit date. It's actually called the roll date, but it's not the same as expiration. Now, the thing that you want to remember is, as we see if there's a continuous chart, right? If you're on Thinkorswim, you've got your /ES. If you're on TradeStation, it's the @ symbol, ES. So whatever that may be, if you're looking at a continuous contract up until today, and make sure you know what your charting platform uses as a date to transition from the previous contract to the next, right? Do they use the roll date, which is basically today, or do they use the expiration, which is next week? So look at where we're trading. So see the difference here? That's 904.25. Here's 909. So we know there's about a 5-point difference between the two. So when a platform like this stops showing the price reflective of September and start showing the price reflective of December, you immediately are going to get what? Approximately a 5-point bump. So when the roll would elicit essentially the possibility for a gap up or prices to be trading higher as we transition from September to December, yeah, there's a little bit of an expectation for strength. Just like if you're rolling where the front month was higher, like this is what this situation is, but what if the front month was lower? What if we were moving from September to December, the price is lower in whatever commodity or futures contract you're looking at, right? Then we would look for weakness. We would look for the downside move, not the up. And so that's how we look at this date. That's it. I don't really look for a whole lot more than that. I don't think there's any specific volatility that I would say I would hang my hat on. I just know that psychology of this gap, and there's only two kinds of gaps, right? There's these natural gaps that occur when the markets open and close, and then there's this kind of gap that occurs when we have the contract rollovers. Now, you take all that, and then you think about what we did this morning, and I'll definitely talk about this more in the premium video. But one of the things that you want to remember is, yes, there's going to be a tendency for December to reflect a little bit more strength in September. And then we still have our overall bullish bias. When we look at every one of these daily time frames, we already have a bullish bias. I mean, why on earth, after a pullback, would I want to be aggressively short a market that has yet to plot in the last month or so a single red grab candle on the daily? We absolutely still have what we call bullish bias. Now, the one thing that I think was really important, and when you review, say, the replay in the members area for this morning's setups, or, and like I said, I'll talk about it in the premium video as well. One of the things that I want you to think about is how we did not trade. We kind of waited. The bell rang and we were looking for our projected lows, and they didn't come. So we went all the way out to 10:30 waiting for our projected lows, and they still didn't come. So we realized, oh, well, if 9 to 10 isn't giving us our projected lows, we'll adjust and start looking for 10 to 11 o'clock projected lows. And that's when it came. That's when we ended up getting into the market and then looking for the movement to the upside, right? But this right here is the reason that these PMRs are so important. Because if I was just overriding that PMR, that projected low, if I was overriding that, who knows what I would have gotten into, and likely steamrolled. But because we bought at that low, that's what gave us a lot of choice. And remember, it didn't happen in the first 30 minutes or even the first hour of the day. It took almost 90 minutes before we got that level and play. And then we saw the follow through. The same thing happened on the S&P, same thing happened on the NASDAQ, same thing happened on the Dow. All right, so think about that. How patient are you being, and are you respecting that overall movement? And then absolutely, as we are looking at currency rollovers in the index futures and in the currency futures, remember, look at the previous month, look at the front month, and is it a gap, potential gap up or momentum up or down? And look at the space in between these. This one's about 5 points, right? So make sure you take a look and just be aware which direction we're likely to see prices plot in as a continuous contract on any platform is going to reflect the new front month. Hope that makes sense and hope that helps.